So yesterday, I talked a little bit about how to value bank stocks. Today, I want to talk. By the way, probably right there. Um, there's a link to that video. Anyway, today I wanted to talk about Citibank and do a quick valuation on them using the principles that we discussed about yesterday. The thing is that these things, these banks, these financial institutions, the way that they work is that they are taking your money and reinvesting it, right? In a lot of ways, the equity side of a bank doesn't look too much different from the liability side, right? It's all just money at the end of the day that they're going to use to loan out and make a profit from the interest, the interest spread. Now, the only difference is that the equity tends to be a little bit more expensive. And so the way that you should look at it as a consumer, as an investor in a financial institution, is that you should be looking at the bank, the equity in the bank, and dividing that by the number of shares outstanding to get a value per share. And that is how much money you need to buy it for less than, right? Because at the end of the day, it's just a bank account, which is kind of a weird way to think about a stock. It is literally just the bank account. It's an account at the bank. And I've mentioned this yesterday. It's no different than making a deposit into a credit union, right? That is exactly what a deposit in a credit union looks like. It looks exactly 100% on the balance sheet of a bank, like a share in the bank, right? So look at it as a miniature bank account that's earning some sort of amount of interest, right? And the interest that you're going to get is the dividend. There are additional risks that come along with that, but if you can purchase the bank account for less than what it's worth, then it makes sense to buy shares in a bank. So today we're going to be talking about Citibank. Right here I have my copy of their most recent annual report, and I have been going through it and making some notes. Now, there are three numbers that I care about when I'm looking at a bank. The first number that I care about is the expense ratio. That will let me know, is the bank utilizing your money well? The lower the expense ratio, the better. Literally what it is revenue divided by it. Sorry, I got that backwards. It's the operating expenses divided by essentially net revenue. That's it. That is 100% it. That is all that the efficiency ratio is. And so that's the first number that we're going to look at. I calculated the efficiency ratio for Citibank and for the last 3 years, because that's what they gave me, and this financial report is 3 years worth of income data. And what I got was in 2019, their expense ratio was 56.94%. In 2020, it was 58.77%. And in 2021, it was 67.04%. Now, what I want to pay attention here is the trend line, right? This trend line is not great because remember, the lower the number, the better. And every year, it's gotten worse and worse and worse. As a matter of fact, there was a huge jump of almost 10%, right? Almost 10% jump from 2020 to 2021. That is very scary. And it really speaks to the case of why Citi is trading so low these days. Now, that's the first thing. That's just the story. They're becoming less and less efficient. That's worrisome because what it means is that they could dip into unprofitability. But it could also mean that they're making investments and things to build out the business. Now, the next number that I like to look at is why that is one of the drivers, the main driver that I care about in a bank for that expense ratio. Now, there are some other things like overhead that are important, like how much money you're spending on salaries and that sort of thing. But that tends not to be the biggest issue when it comes to a bank. The biggest issue that really matters the most is the losses on loans. That's what's going to kill you in a bank, right? How are they managing the losses on a loan? Now, I like this number to be between 40 and 60 basis points, somewhere in that range. That tells me that they're being disciplined, but they're not being overly disciplined, right? They are actually lending money out. If it's less than 40 basis points, they're being too stingy. They're not lending the money out. They're not making any money. If it's over 60 basis points, that's when I start to wonder if they're being too aggressive and they're lending out too much money, right? And they're taking on risks that they shouldn't be taking on. So that's sort of the Goldilocks range is between 40 and 60 basis points. Again, a basis point for anybody that does not think in terms of that is 1% of 1% is 1 basis point. Right, so 100 basis points equals 1%. All right, so looking at these numbers, I'm just going to read them off to you. These numbers go all the way back to 2017. In 2017, their net loan losses as a percent of loans was 108 basis points. In 2018, it was 105 basis points. Again, I'm looking for something between 40 and 60 here. So this is really high. But it did move in the right direction between 2017 and 2018. But then it took a big step up in 2019. They ended up with 113 basis points. That's almost, well, we'll get there. In 2020, it became 117 basis points. That's almost double what I think is the top mark for where this number should be. So Citibank is taking some risky A loans, right? They're giving out some risky loans. And so I think that's what's probably driving their expense ratio going up. They gave out the risky loans in the financial sector. These are the subprime. These are the scary ones. These are the ones that are going out to international investors and things like that, right? Now, the good news is that in 2021, they had a massive drop in this number, and I take that as a very good sign. I'm going to be interested in seeing what this looks like in 2022. And I could probably pull out quarterly statements and things like that to get an idea of where do these guys sit at, right? But in 2021, they landed at 75 basis points, which is a lot closer to the top end of my range that I'm looking for. If they keep moving in that direction and get down to that 60 basis point range, and if they're moving in that direction for credit losses as a percent of loans, this is going to be a good sign for them, right? Now, there are other things that you want to take into account in terms of risk management, right? Interest rate risks and blah, 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 all that sort of stuff. And all of that is in here in the annual report, right? But for me, the number one risk that you want to look at is the loans, because the loans are going to kill you the fastest, right? So be careful with the loans. That's their primary function, is to take money in and loan it back out, right? And if they're doing a bad job taking too much risk in that area, that's where they're going to get you slaughtered, right? So that brings us all the way back. That's my thoughts on Citibank. I think that they are moving in the right direction in terms of their risk profile. I do think that that their expense ratio has reflected the increase in their expense ratio, has reflected the fact that they have been giving out some really risky loans, and insofar as Citi is consolidating into less risky loans, and they're bringing things more in line with where they should be, I think this could be a good investment, right? So the only question now, and again, you're going to want to read through the rest of all of the risks and the risk mitigation strategies that they're undertaking. And again, all of that's available in their Form 10K. But and you should read it, and you should understand where those risks are. But assuming that those numbers sort of make sense and gel with you, and you want to make an investment here, I personally don't. I'm kind of a waiter on this one. I'm going to sit around and wait, because of, they are taking more risk than I personally like a bank to take before I put my money into it, right? Because you're going to get clobbered, right? I want to see that I want to see that net loss get into my range. I'd like to see this expense ratio come back down to at least under 60%. I think that makes a lot of sense. If they can get their efficiency ratio to 60% or less, then this becomes a very attractive investment, right? So the only thing that's left is the valuation here. And I want you to be careful with this valuation, because banks tend to have preferred shares, and those preferred shares tend to come at a higher par value than other types of investments, right? Than common equity. And you're probably going to be buying common equity in the company, in the bank, right? So taking a look at this, Citi has two classes of stock. They have a preferred and a common, right? The preferred is worth 100 times more than the common. So when you take a look at the number of shares, you need to multiply the preferred shares by 100, add that to the number of common shares, and that will get you a grand total shares outstanding in common share equivalents, we'll call it, right? So we'll do that, and then we're going to take the equity value and we're going to divide it by the common share equivalents that we calculated. When we do that, we get a book value of $65.05 per share, which sounds great because the share price is $52 a share, which, yay, we can make some money here, right? We're literally buying $65 for $52, essentially. The year before that, they were at $63 per share. So yeah, this looks like a no-brainer, right? except I have a problem, right? The Citi actually has a lot of intangible assets on the book. Namely, they have other intangibles, which I don't even know what they are, and they have goodwill from acquisitions that they've made. I want to pull those two things out of the calculation for equity. So we're going to subtract those two line items from total equity. And then we're going to rerun the calculation. So netting out the intangibles to get the tangible book value, and then dividing by the number of common share equivalents outstanding, we get a tangible book value price of $55.70 a share and $54.54 a share the previous year. Again, the share price is $52 per share right now, but that doesn't look terribly exciting to me. That actually looks kind of scary to me. At $52 per share, yeah, you're getting kind of a deal, but you're not getting a great deal, right? Just really quickly, you're getting $55.70 divided by the about $52 that it's trading for in the market currently, plus or minus, right? The share price jiggles around quite a bit. And you're only talking about a 7% return here, right? Which, okay, that's decent. Plus you'll get the dividends. So you're talking 7% for the first year, plus I don't know what the Citi is paying in terms of a dividend. We can look that up really quick. You'll get about a 4% return as of today on that. So you're talking about an 11-ish% return for your investment in the first year. That's it. That's all you're going to get from Citi right now. And so I'm looking at this and I'm going, this doesn't seem like a really great deal. Now, if it kept going down a little bit and we could pick it up for a little bit more, say $45 a share or something like that, I might get interested then. I was using a 52% or a $52 per share expectation, but the market has been kind of cruel in the last couple of days. So let me rerun that number with the number that it is today, which is $51 a share. And you're getting closer to a 9% plus the 4% that you're going to get. So 13% for a year investment in Citi. It's not bad, not terrible. But I would probably wait a little bit longer on this one. I'm not a big fan of like I said, I'm not a big fan of their risk strategy over here at Citi. They're a big bank. They've got a great brand. They're doing a lot of really good stuff. I'm just, the risk reward just isn't there for me right now. It's starting to. It's looking pretty interesting. But, if it sounds interesting to you, you might want to consider buying Citi. I have been, because I noticed that the book value, at least how it's being reported to me, was much, much higher until I adjusted for cash or common share equivalents. And then I was a little bit less impressed. But it's getting there, right? It's in the range where it's starting to make sense to me. I know Warren Buffett made a big bet. I guess it makes a lot of sense to him. But I'm just not there yet with Citi. But this gives you a good example of what an and how to value a bank stock, right? So take that for what it's worth. Until next time, stay rational, my friends.